Let me tell you a story that should absolutely infuriate you. In 2008, when the housing market crashed and millions of American families lost their homes to foreclosure, Wall Street saw an opportunity. While everyday people were devastated, losing the equity they'd spent decades building, a handful of investment firms recognized they could buy these distressed properties for pennies on the dollar. But here's what nobody predicted back then. This wasn't just opportunistic bargain hunting. This was the beginning of the largest wealth transfer from the American middle class to Wall Street investors in modern history. Fast forward to today, and we're living in a completely different housing landscape than the one our parents and grandparents knew. The traditional path to building wealth in America has always been straightforward. You work hard, save money, buy a home, and over time that home appreciates in value while you pay down your mortgage. Eventually you own it outright, and that equity becomes the foundation of your retirement security. It's how generations of Americans built financial stability and passed wealth down to their children. But that entire system is being dismantled right before our eyes, and most people don't even realize it's happening. Let's talk about who's actually behind this. You've probably heard names like Blackstone, Invitation Homes, American Homes for Rent, and Progress Residential. These aren't your typical landlords. These are institutional investors managing billions of dollars, and they've been systematically buying up single-family homes across America since the last financial crisis. Invitation Homes alone owns over 80,000 properties. Think about that number for a second. 80,000 families who will never build equity, never own their homes, and will be perpetually sending rent checks to a Wall Street firm. But the scale goes even deeper than individual companies. When you add up all the institutional investors, private equity firms, and real estate investment trusts buying single-family homes, you're looking at that staggering $2.1 trillion figure. This isn't scattered investment happening organically. This is coordinated, strategic, and it's accelerating every single year. These firms have created entire divisions dedicated to acquiring residential properties, employing algorithms and data analysts to identify target markets, and they're moving faster than any individual homebuyer possibly could. Here's how they're winning. When you or I decide to buy a house, we have to get pre-approved for a mortgage, make an offer, go through inspections, deal with appraisals, and hope everything works out over a 30 to 45 day closing period. We're constrained by what we can afford, what the bank will lend us, and we're competing against other families in the same position. But when Blackstone decides to buy a house, they pay cash. No mortgage contingency, no financing falling through, no waiting. They can close in 7 days, sometimes less. They'll offer above asking price because they're not worried about appraisals or whether the monthly payment fits their budget. They're thinking about long-term returns, portfolio diversification, and rental income streams that will generate profits for decades. Imagine you're a seller with 2 offers on your table. One is from a young couple with 2 kids, pre-approved for a loan, offering asking price with a 45-day close. The other is from an investment firm offering 10% above asking, all cash, 7-day close, no contingencies. Which offer are you taking? It's not even a difficult decision from the seller's perspective. They're going with the sure thing every single time. And this is happening in neighborhoods all across America, in cities and suburbs you wouldn't necessarily expect. Now, you might be thinking this is mainly happening in expensive coastal markets like San Francisco or New York, but you'd be wrong. These firms are deliberately targeting mid-sized cities and growing suburban areas where prices are still relatively affordable and rental demand is strong. Places like Atlanta, Phoenix, Charlotte, Dallas, Tampa, and Jacksonville have seen massive institutional buying. Why? Because these markets offer the perfect combination of appreciation potential and rental yields. Young families want to live there, jobs are growing, but home prices haven't reached the stratospheric levels of the coasts yet. It's the sweet spot for investors looking to maximize returns. And here's something that should really concern you. These companies aren't buying homes to eventually sell them. They're building permanent rental portfolios. They've discovered that single-family rentals are incredibly profitable. Think about the economics from their perspective. They buy a house for $300,000 in cash. They rent it out for $2,000 a month. That's $24,000 a year in rental income. Even after property taxes, insurance, maintenance, and property management fees, they're clearing a healthy profit while the property appreciates in value. And unlike apartment buildings or commercial real estate, single-family homes are remarkably resilient investments. People always need places to live, and families will pay premium rents for houses with yards in good school districts. But the real genius of their strategy, if you can call it that, is the scale. When you own one rental property, you're at the mercy of vacancies and maintenance costs. One bad tenant or one major repair can wipe out your profits for the year. But when you own 10,000 properties spread across multiple markets, you can absorb those risks easily. You have professional management teams, bulk purchasing power for repairs and maintenance, and sophisticated systems for tenant screening and rent collection. You're essentially running a factory that manufactures rental income, and the machine keeps humming regardless of what happens to any individual property. Now let's talk about what this means for you, because this isn't just an abstract financial story. This has real consequences for real people trying to build real lives. If you're a millennial or Gen Z trying to buy your first home, you're not just competing against other first-time buyers anymore. You're competing against firms with billions in capital who can outbid you on every property. The house you've been saving for, the one in the neighborhood with good schools where you imagined raising your kids, gets snapped up by an investor before you even get a chance to make an offer. The bottom line is this: what's happening in the housing market right now is not natural or inevitable. It's the result of specific policy choices, regulatory frameworks, and economic conditions that favor institutional capital over individual home ownership. The $2.1 trillion bet Wall Street is making against American homeowners is only possible because we've allowed it to be. We've created systems that prioritize investor returns over housing stability, that treat homes as financial instruments instead of the foundation of community and family life. This fight isn't over, but time is running out. Every day, more homes transfer from individual ownership to institutional portfolios. Every year, home ownership becomes more difficult for regular Americans. If we want to preserve the opportunity for future generations to own homes and build wealth, we need to act now, demand policy changes, and make it clear that housing should serve people first and investors second.